We are continuing our podcast series for M&A deal makers and advisors that transact on both sides of the Atlantic. As we know, M&A deals in Europe, the UK, and the US often follow different practice parameters, terms, and conditions. And today we're going to explore some of the key differences and approaches to M&A insurance products in those markets. We are joined by an expert panel from the market-leading global M&A insurance broker Aon, and my partners and colleagues from the Global 10 international law firm Eversheds Sutherland. John, let's jump right into it. You're situated right in the heart of the Midwest of the United States with Aon and are very alert to the type of M&A transactional services and insurance products offered by the U.S. market. They seem to be ever evolving and developing at a pace that few of us lawyers can really keep abreast of at all times. What are some examples of products or terms and conditions that have come to the market in the U.S. of late, and particularly any in relation to deals that may have some sort of cross-border element to them?
Yeah, good question. And thanks for having me on. Just for the listeners, I'm a senior broker on Aon's Transaction Solutions team based out of Chicago. So I guess to start, as is probably obvious, we in the U.S. work very often with foreign buyers of U.S. businesses, and you're 100% correct that the market for rep and warranty insurance is changing at an extremely quick pace. We here on the brokerage side, we're focused on constantly innovating to make the product responsive or more responsive than ever to issues that clients have had and areas where they and counsel have had issues either on the front side during the underwriting process or on the back side with claims. And we do structure things a little bit differently depending on what the parties are hoping to achieve. And certainly including where they're located. In today's market, the underwriters that we work with are very sophisticated and they want to be creative. And so especially as the M&A market has been softer over the last couple of years, they have, I won't say they haven't bent over backwards, but they've been more willing than ever to find creative solutions where issues have existed. So just as a few examples of things that have been a little bit different over the past few years, some of which will continue as the M&A market hopefully continues to rebound, and some of which might become a little bit more difficult to obtain. But I guess just to get started, we've been arranging for various solutions with deals that are in where the parties are expecting extended interim periods due to regulatory scrutiny in whatever jurisdiction, and that might be antitrust concerns, CFIUS here in the United States, whatever it happens to be around the globe. We're also working with clients to get retentions that are zero or close to zero for certain of the reps that are being made. Typically, those are the true fundamental reps. We've also been working with underwriters at different markets to get them comfortable ensuring deals in very unusual jurisdictions where there would have been no market appetite for doing just a couple of years ago. And then lastly, we've had a very good response to a couple of proprietary solutions that we've rolled out relating to getting coverage for deals with interim periods so that we can cover true interim breaches, and now including the ability on certain larger deals to even get an insured's retention reimbursed when they incur certain large losses. I guess I'll just close out by saying that we're at a point in the market where there's so much data available on claims frequency, severity, and exactly what is driving the losses, that my expectation is that as the years continue to go by, that additional data is going to allow the market to continue to innovate probably faster than ever and make the product even more responsive to the needs of deal makers.
Thanks, John. Nicole, you're literally sitting on the other side of the Atlantic, in the heart of Europe as we speak right now, and often are guiding deals throughout the continent for both European and U.S. clients. How are M&A insurance products taking shape in Europe, and how is the product offering in the U.S. and Europe diverging or maybe converging to meet the demands of local practice requirements?
Thanks, Ted. Just as a bit of background on myself, my name is Nicole Rondi. I head up the transaction solutions team for Aon for the DACH region. So that is Germany, Switzerland, and Austria. And as a background, I was an M&A lawyer with Linklaters in London and Paris and Alan Nobery in Singapore. So my experience is extremely cross-border, shall we say. But to go to the sort of to your question, but some, not all, but a lot of US buyers in Europe will obviously try to push for a more US style SPA because this is what they know. And this goes from, on one end, trying to make the SPA subject to US law and everything that goes with that, including an R&W policy, to the other end of accepting local law, but trying to insert US SPA features and pushing that into the related insurance coverage. As Simon said in the previous podcast episode, investors who are familiar with reps and warranty insurance, they want to ideally replicate that coverage and process in Europe. And as more insurers have developed globally and understand both products, they have increasingly been able to accommodate these types of requests. In particular, we have seen a lot of inbound US investments into Europe in the last couple of years, which combined with the softer M&A market that John was talking about, and therefore the more competitive insurance markets, this has helped to really drive a change in the W&I policies, not just the reps and warranty policies, as if the US investors have that bargaining power to include the US elements in their SPA. They really want these elements in the W&I too, and the insurers have had to bend over backwards to try and accommodate these. And by these, I'm thinking of VDR scrapes, nil de minimis, materiality scrapes, interim breach cover, no warranty spreadsheet. All of these things are not things that we would have traditionally seen in warranty and indemnity insurance, but these are pretty standard in reps and warranty insurance. We had a very large US inbound deal into the DACH region in early 2023. And this deal was pretty instrumental in achieving certain US style enhancements that we hadn't achieved before. This was a very large deal, and the majority of the insurance market was on this very large tower in order to build the capacity that we needed. So we like to think that this has sort of acted as a Pandora's box to open the market to more US style enhancements because everybody followed this, so they've had to offer this going forward. How much is really achievable has been traditionally dictated by the style of the SPA and the disclosure process. The reason we think that it has been quite successful in getting US style coverage into the DACH region in particular is because, for instance, the German practice is to rely on both general disclosure of the VDR and also to produce extremely detailed disclosure schedules, quite akin to a US transaction. Therefore, the insurers in DACH have been very willing to adopt certain US style enhancements, particularly the VDR scrapes or materiality scrapes. If you compare this with certain other jurisdictions in Europe, for instance, I think some of the Nordics that rely entirely on general disclosure, this is not something that has been able to be put into a W&I policy because otherwise there would be no disclosure. But the DACH region, because of those particular features, has been pretty successful in getting these enhancements into W&I policies. The market, to begin with, is willing to allow such enhancements if they were provided for in the SPA. So it was following the SPA terms only. I think where the real movement that we've started to see is, given this really soft market and the need for the insurers to be so much more competitive, particularly in Germany, the insurance market has really had to offer these enhancements synthetically now to the SPA. So this means that we're often seeing these additions regardless of no US client involvement. So these could be market standard now offered to an entirely European deal just for an additional premium.
Thanks, Nicole. Not sure how I feel about a leading American export being a materiality scrape these days, but interesting to hear nonetheless. Evan, you have very practically been in the weeds when it comes to onboarding, negotiating, and binding insurance policies for deals in the US, the UK, and in Europe. And you've had to deal with insurers in all those different markets who have different styles, terms, and approaches. What jumped out at you as some of the key practical differences when getting through the sourcing, underwriting, and binding processes? And have you started to have a preference in respect of any of the differences in approach adopted by those different markets?
Yeah, thanks, Ted. Hello, everyone. I'm Evan Johnson. I'm an associate in the corporate team based in Chicago and have been practicing for over 5 years, primarily in cross-border M&A transactions, many of which have involved rep and warranty insurance or W&I policies as applicable. So I have had good exposure to see how things have developed in this area as the M&A market has evolved considerably in the last couple of years. Based on my experience in relation to sourcing, the market has advanced a lot in recent years with the availability of such policies being broadly available. Insurers are very willing to be accommodating and providing coverage where needed. In the United States, it's incredibly easy to get coverage. And in Europe, it's also generally very easy to get coverage should the target be based in Western Europe. To the extent the target is in Eastern Europe, there tends to be a few more initial hurdles to overcome, such as in relation to regulatory matters. That being said, as John noted, insurers have become much more flexible in trying to work through this and achieve creative solutions to obtain coverage to best suit the parties. As for the underwriting process, in Europe, the process is moving much quicker now than historically it used to be, with timing much more like the United States in terms of it being achieved within a matter of days versus a matter of multiple weeks. In Europe, the process is usually driven by specific targeted written questions based on a close review of the diligence reports produced for the deal. Of note, in Europe, there is greater seller involvement in the underwriting process, including the preparation of very detailed vendor due diligence reports. On the other hand, in the US, the underwriting process is more condensed to having a single underwriting call with a handful of written follow-up questions as may be needed afterwards. Usually the call is a broader discussion on the business and relevant legal matters, usually informed by the diligence reports that are produced tailored to prior to the call, but many times calls are still very generic overviews on the business and the transaction. Unlike Europe, the seller is rarely involved in the underwriting process, nor in the preparation of the diligence reports, other than assisting the buyer with any Q&A follow-up resulting from the underwriting call. And my preference, of course, I think being a US attorney, is I feel that the US style underwriting process tends to be a little smoother and, as I said, generally is still condensed and shorter than a European style, but the processes for both are becoming much more aligned. Moving into the policy itself, in generally, there are more deal-specific exclusions, such as those arising from deemed disclosures from the diligence reports and the disclosure letter. As discussed in an earlier session, the disclosure in European deals is significantly broader than a disclosure schedule in the US, with broader disclosures and references to the data room generally. In the US, the disclosure schedules are more negotiated as buyers try to avoid drawing the insurer's attention to certain matters and then potentially forcing an exclusion in the policy. Other key distinctions on the policy itself is that the definition of loss is usually much broader in the US and will follow the purchase agreements approach. Additionally, the policy in the US will usually include a materiality scrape, at least if the purchase agreement includes one, whereas as discussed earlier, such a scrape in Europe is quite rare. Finally, as Nicole noted, there is a growing trend to have more transatlantic deals follow a US-style RWI policy than a W&I policy.
Many thanks, Evan, for that very helpful perspective and insight. And many thanks again to our panelists, Simon, Nicole, and Evan from Aon and Eversheds for sharing with us their experiences into the key differences between M&A insurance products in the US, the UK, and Europe. That wraps up the second part of our three-part podcast series, focused on the key distinctions between US and UK Euro M&A deal terms and the M&A insurance products used on both sides of the Atlantic. Please join us next week for our third and final podcast as we continue to explore the key differences in approach to M&A transactions on both sides of the Atlantic and how those differences may be starting to diminish a bit as deal terms and insurance products increasingly converge. Thank you.